This is Rob Hansen with Locumstory.com. Locumstory.com is an educational resource helping physicians, PAs, and NPs learn about locums, how it works, and how it can fit into their career paths. Tonight's topic is managing your money during a pandemic, a super critical and very timely topic. And we are very fortunate to have a really great guest, Dr. Daly. And we've been lucky to collaborate with him over the past 3 or 4 years, and we're really happy he was able to join us tonight. You're probably all familiar with Dr. Daly, but in case you're not, he's a practicing emergency physician in Salt Lake City, also a US Air Force veteran. And almost a decade ago, he created a website called The White Coat Investor. In his spare time, he enjoys canyoneering, skiing, biking, and spending time with his wife and 4 kids. Before I turn the time over to him, just a few housekeeping notes. If you have any questions, be sure to ask them in the Q&A function on Zoom. And at the end, we'll have a Q&A. We'll spend about 15, 20 minutes talking or doing Q&A with Dr. Daly. If we don't get to your question, don't worry. We will ask him the questions offline, and we will post those on the blog when we share the recording of this webinar. So without further ado, I think we're going to turn the time over to Dr. Daly.
All right, let's see if we got all the AV functions working here. See if I can advance the slides. There we go. It's a little bit delayed, but I think I can advance the slides here, Rob. I'm sorry those of you out there are not able to come to a live Locum Story event. These are great. I've been doing these at typically big physician conferences for the last 3 or 4 years, probably most notably at the American College of Emergency Physicians. And Locum Story buys you drinks, they buy the food, they buy you a copy of my book. We all have a good time for a couple of hours. And it's just a really great evening event. Unfortunately, in the pandemic, this is the best we can do. So I hope it's worthwhile to you. I hope we get you some good information. And at least you get the presentation, the meat of the event, even if you can't enjoy the great social time that we usually have with them. So we're calling this an hour with the White Coat Investor, managing your money during a pandemic. I think it's going to be really great. If we don't cover what you like during the presentation, we'll stick around after and answer your questions. So obviously, this is a sponsored event. I want to thank Locumstory.com for sponsoring it. If you're interested in learning more about doing Locum Tenens, we'll mention a little bit of that in the talk, but be sure to check out Locumstory.com. That's actually the primarily educational arm of the company that just teaches you about what locums is and how it works. All right, so for those of you who don't know me well, I thought it would be worthwhile telling a little bit about the story of the White Coat Investor, maybe why you should listen to the rest of this talk. I first got interested in personal finance and investing in business about halfway through residency. I had zero interest as an undergrad, no interest during medical school, and little interest as I started my residency. But I found that I kept getting ripped off every time I interacted with a financial professional, whether it was a realtor or a recruiter or a mortgage lender or a financial advisor or an insurance agent. I always got the raw end of the deal. And so about halfway through residency, I decided I needed to start learning this stuff on my own so they would quit taking advantage of me. And after a few years of doing that, reading books and spending time on online forums, I found I was answering a lot more questions than I was asking. And I realized that nobody was teaching this stuff to docs, not in medical school, not in residency, not outside of those venues. And so I thought I'd start a website. So I quit typing the same thing over and over again into the internet forums. And so in 2011, the White Coat Investor was born. It took off pretty quickly because the need is obviously so great. It's been followed up by a book or two. The first one was published in 2014. Now a podcast that's actually more popular than the blog that started in 2017. We had our first live conference in 2018, another one this year, and launched an online course that same year. But perhaps the most interesting thing about this story is because I got this information during residency, I was able to hit the ground running as an attending when I first got that attending income and apply these principles in our lives. And that allowed my wife and I to become millionaires by the time I was 38 and she was 35. So I was 7 years out of residency and we were millionaires. A lot of people think that's pretty interesting, pretty notable. Honestly, though, most doctors should be able to do that. And the formula to do so is really not all that complicated and relatively easily reproducible. So before we get too far into this, I probably ought to do some disclosures and disclaimers. The White Coat Investor is a for-profit business. The website's for profit. The information there is totally free to you, but if you go there, you'll see ads, and I actually make money from those ads. But I'm really big on disclosing my financial conflicts of interest, so you'll find that there. But if you buy my stuff, you come to my conference, or you buy my online course, or you buy one of my books, I actually get paid. So you should be aware of that. I'm an emergency physician. I had a shift today until 2 o'clock. I'm not a licensed accountant. I'm not an attorney. I'm not a financial advisor. So this presentation is for your entertainment and general information. It's not formalized, specific accounting, legal, or financial advice. And also, it's important to have this caveat, I think, in any talk to doctors about finances. Money doesn't make you happier. You didn't go into medicine primarily for the money, and neither did I. But if you ignore it, it can make you really miserable. And so what I want to do tonight is give you remove the taboo that we have in our medical centers and in our hospitals that we can't talk about. It's okay to talk about money because our own financial illiteracy is affecting our patient care. There really is a connection there. And so I think it's important for us to become financially literate. So here's what we're going to talk about today. We're going to talk about how financial literacy matters, how it's your second job, how it actually prevents and treats burnout, the importance of playing both offense and defense. And then I want to go over 5 lessons from 2020 that I think can be applied from what we've learned in the last 5 or 6 months. The first one, the income is not secure, that following a written plan really does work, that if you see a free lunch, you probably ought to eat it, that the best use, that there are some really good uses in a bear market, but that dumb stuff is still dumb. And we'll get into a lot of the dumb stuff that doctors are doing out there today. So first thing, financial literacy matters. And here's a picture of my daughter and I up on Pingora in the Wind River Mountains. So one of the beautiful things I love to do when I'm not working in the ER or working on white coat investor stuff. So medical school and residency made you a clinical expert, but it gave you no business training, no personal finance or investment training, and now you're being asked to be a pension fund manager in our 401k world. You're responsible for your own retirement. You may also be your family's chief financial advisor or chief financial officer, and maybe even your practice's chief financial officer. So the process of becoming wealthy is not that hard for doctors by virtue of their high income, but it is not automatic. There's actually a few things you have to do. It's interesting if you look at the data. If you just ask doctors, what is your net worth? Net worth, of course, is everything you owe minus everything, or everything you own minus everything you owe. So all your assets minus your liabilities, that's your net worth. So if doctors are asked this, this is how they answer the question. As you might imagine, for doctors in residency in their 20s and just out in their early 30s, most of them are not millionaires. But as time goes on, you'll see that more and more of them become millionaires or even achieve a net worth of more than $5 million. But the problem here, as I see it, is in those age groups of the 60 to 64 and 65 to 69-year-olds. You will see there that approximately 25%, or 1 out of 4 doctors, is still not a millionaire by retirement age. Now remember, this is everything. This is the value of your house. This is your retirement accounts, your checking account, your cars, your stuff, everything. Not a millionaire. And if you break this data down further, as they have in some past surveys, you'll see that 11 to 12% of docs do not have a net worth of even $500,000. And I think that's a real tragedy after 30 years of physician paychecks. So I like to work hard to try to avoid that happening. My main goal is to make that percentage of doctors much smaller. You know, there's other interesting data from those surveys that you'll see. For example, you can see that different doctors make different amounts of money. It's no surprise to find orthopedics and plastic surgery at the top of the list, nor to find family medicine, preventive medicine, pediatrics at the bottom of the list. We all kind of knew that in medical school. But what's interesting to me about this is that the range of incomes within any given specialty is far larger than the range of incomes between the averages of each specialty. That is to say, the intra-specialty variation is much higher than the inter-specialty variation. So here's some more of that net worth data. This is everybody put together. You'll see that about 50% of doctors are not yet millionaires. So of those who are worth over 5 million, what specialties do they tend to be in? Well, they tend to be in the higher paid specialties. No surprise there. But if you can achieve, a net worth of $5 million in one of these less lower paid specialties, you're certainly in the top 10% of doctors. And the main reason that doctors aren't accumulating a lot of wealth, despite making $200,000, $300,000, $400,000 a year, is that they don't save much money. If you actually ask them, how much are you putting into your tax protected accounts, whether for retirement or college savings, you will see that only 40% of them put $2,000 or more in there. And the other 60% is putting in less than that. In fact, a significant chunk, it looks to me like, what is that, 30, almost 40%, 35% are saving less than $1,000 a month into those accounts, which is really just inadequate savings. It's simply too low of a savings rate to really build wealth. In fact, if you look at their savings outside of retirement accounts, the numbers even worse, right? So it's not that they're just not using their retirement accounts, it's that they're not saving at all. So the bottom line is you have to spend some time learning about finances and business. You have to learn the terminology. Just like medicine, it has its own language that you have to learn. You have to get an initial financial education. And one of the great ways to do that is to do what I did, read a bunch of books, spend some time asking questions on internet forums. There are other ways to shorten that process. You can take an online course like the one I put together just for this purpose. That costs a little more, but saves you a lot of time. You can also go out and hire a financial planner, and they can help you put together a financial plan and help teach you this stuff. That obviously costs the most, but requires the least effort. Once you become financially educated, it's important to have some continuing financial education each year. I recommend you follow a good blog or two and that you read one financial book a year. In fact, the first really good financial book that you read may be worth $2 million or more to you over the course of your career, because it helps you to change your behavior, helps you to make smarter financial decisions. And when you apply that to the earning potential of a physician and compound interest over a career, it truly can add up to millions of dollars a year. When you hire professionals, whether it's an attorney or a CPA or a financial advisor, whoever it is, hire them to teach you, not just to do it for you. And that way you're learning as you go along. You also have to spend time taking care of your business. We all just want to be 100% clinical. We just want to take care of patients. But the truth is, if you neglect it completely, you're probably not going to be financially successful. All right, let's move on to number 2 here. It is my contention that financial planning actually prevents burnout. It actually does. It really can improve the way you feel about your job, improve the way you feel about your life, and improve your job because it gives you the power to make improvements. If you look at what doctors are most burned out these days, we have a new winner at the top of the list, urology. I'm pleased to see that emergency medicine and critical care medicine, who are the traditional losers of this question, have moved down the list quite a bit. And I wonder if that'll be different after the pandemic's over, but this is the way the numbers stand right now. The really upsetting thing about this is that most of these numbers have gone up since last year after several years of trending down in this survey. But financial planning helps prevent burnout in a number of ways. First, it helps align your values with your time and money. If you know what you care about, you can spend your time there and you can spend your money there and not spend it on stuff that you don't care nearly as much about. And the process of financial planning requires you to actually look at your values, to set your goals, and to really align your life with those. If you plan, you're more successful. You become financially independent earlier. And I can tell you this from personal experience, medicine is way more fun when you don't have to practice it. When it becomes a well-paid hobby, it's just a lot more fun. Financial planning helps you decrease your fixed expenses, and that gives you a lot of benefits. It can help you to live on less money, for instance. It also gives you what in polite company is called walkaway money. In less polite company, it might be called FU money. But either way, it gives you the ability to make changes, whether it's walk away from a job completely, force the employer to give you better terms or better call or whatever. It basically allows you to consider lifestyle improving options. You can have fewer hours, you can work fewer evenings, nights, weekends, and holidays. You can buy your way out of call, you can change jobs. You can even change professions if you're just sick of medicine. It's interesting. I often, when I'm in a live group, I do a survey and I ask people, how many of you, if I wrote you a $10 million check today, how many of you would not show up to work tomorrow? And honestly, it's only ever 1 or 2 hands that go up. But if I ask them, how many of you would still be working the same number of days a week or the same number of shifts a year from now, almost no hands go up. The truth is, all of us would like to work at least a little bit less, and having our financial ducks in a row allows us to do that. Okay. Here's another important concept. A lot of times when you get into financial blogs and financial books, they start talking a lot about just defense, but it's really important to play on both sides of the ball. Let me tell you what I mean by that. There are 4 keys to building wealth. It's really not that complicated. If you make a lot of money and you don't spend a lot of it, and you take the difference between those 2 numbers and put it to work, so your money works as hard as you, and insure against financial catastrophes, you're going to become wealthy. That's really the secret to becoming rich. But you can always outspend your ability to earn. I'm amazed at how easy it is to increase your spending. And so defense is spending less money. But that tends to get all the press in the financial blogosphere. Offense works too. Sometimes it's more effective to work an extra shift than to reuse your paper towels and wash out your Ziploc baggies. Higher earnings make it easier to save money. Even if you're only saving the same percentage of your income, that works out to be more money. It's much easier to pay off debt with a higher income. I see docs with sometimes with student loans in the $400,000 or $500,000 range, and it's simply much easier to pay that off if you can get your income up to $300,000 or $400,000 or $500,000 than if you're making $150,000 a year. Passive income is also helpful. Maybe that comes from real estate investing or other types of investments. If you write some books and get royalties, maybe you have an online business. In a lot of ways, I tell people emergency medicine is the best specialty for entrepreneurs. And it's not just because we might spend fewer hours at work. It's that we work all these nights and weekends and holidays and evenings. And so we're around during banker's hours and during business hours, and gives us some time to work on some entrepreneurial pursuits. But any specialty can do that if that's something they're interested in doing. You just have to be a little bit careful when you're working on passive income that you're not trading your time for less money than you could be making at your practice. A lot of times it just makes sense to make more money actively, i.e. working more shifts or doing more cases or seeing more patients. A lot of times it can make sense to do what we call geographic arbitrage, which is taking a job that pays more. If you go from a high cost of living, say in Northern California, to Texas, you will find that not only your cost of living goes way down, but your income may go up as well. Lots of doctors take on a second job, but you have to be a little bit careful. You have to balance your income needs with burnout, because the more you work, the more likely you are to be burned out. So this talk's sponsored by Locumstory.com, right? And so let's say something nice about Locum Tenens. There are some great things about Locum Tenens. Some docs do it as their main job right out of residency, and that has a few benefits. Number one, you get to figure out what you want. There's a physician blogger out there, the Physician on Fire, who literally, this is what he did his first couple of years out of residency. And the company paid for all his living expenses, and so he banked almost his entire paycheck and became financially independent in his early 40s. And so I actually found his long-term job. I guess long-term is, figurative when you retire in your early 40s, but his long-term job came out of a locums gig. So sometimes locums is just a moonlighting gig for extra money. You get some more hours, maybe your hours pay a little bit more. You can tell them, don't call me unless it's paying $300 an hour or whatever it is you want to be paid. And so you can actually have better paying hours by doing some locums. But most people do it because they're looking for a change of pace. They want a faster pace or a slower pace. They want to see trauma, or they don't want to see any trauma, or they want to go to a unique location. Sometimes people do it during a sabbatical. Maybe you want to go work in New Zealand or Alaska or something like that for 6 months or a year. And that seems to be a big draw for a lot of people. It allows you to go somewhere exotic and do locums, or just someplace different from what you're used to. I've seen docs do locum tenens when they lose a contract, for instance. That's really big in emergency medicine and anesthesia and radiology and other hospital-based specialties, that your group might just lose the contract and all of a sudden you're out of a job. But it allows you to control your hours. You can tell them, I don't want to work nights, or I don't want to work weekends, or I don't work holidays when you set up the contract initially. And then, of course, one big benefit is seeing new places. Okay, let's get into the lessons I think that were most taught to us in 2020. One of the things I like to do that's fun is canyoneering, descending slot canyons in southern Utah. And that might involve swimming or rappelling, sometimes some climbing. But it's really important when you're doing that, especially when there's a lot of air beneath you, that you make sure you are securely attached to the canyon. And a lot of us, when we went into medicine, we knew it wasn't the highest paying job out there. We knew that, Wall Street had some higher paying jobs and some business owners had high paying jobs. But we thought we were at least going to get a secure income. And wasn't that a surprise in this pandemic when a lot of us found out that our income was not as secure as we thought it was going to be? I mean, you would think in a pandemic, when there's all these medical issues going on, that doctors' income would go up or at least stay the same. But what actually happened, and I think this is the most black swan-like of the whole episode, is that our emergency department volumes dropped, our clinic volumes dropped, our elective, and I put that in parentheses, our elective cases were prohibited. A lot of locum tenens docs found they couldn't get a new contract. Patients postponed appointments, they skipped out on them, they didn't get the care at all. So hospitals and pharmacies and doctors all lost revenue. And of course, the insurance companies kept the difference between what they charged in premiums and what they actually had to pay out for healthcare, which I thought was interesting, given that most of our auto insurance companies actually gave us a rebate since nobody was driving anywhere during those months when we were all locked down. But the health insurance companies certainly did not. And to make matters worse, our work became more dangerous. All of a sudden, we're going to work every day and exposing ourselves to a potentially deadly virus that we had to worry about getting ourselves and taking home to our family. And what a lot of docs found out is that even their disability and life insurance became harder to get. All of a sudden, the insurance companies were dragging their feet in giving out these contracts. They wanted to wait to see what would happen before they'd write a contract for a doctor. And so we learned that if you don't have that stuff in place before a pandemic, it might be hard to put it in place during a pandemic. A lot of self-employed docs struggled to make payroll during the pandemic. A lot of employee docs found themselves being asked to forego raises and even take voluntary pay cuts. And I say voluntary because a lot of times, it wasn't voluntary at all. They were basically threatened with loss of their contract if they didn't, agree to those pay cuts, at least temporarily. And so a lot of us found that our income went down during the pandemic, which was terribly disappointing. The only consolation, of course, was that our spending went down pretty dramatically, and we found out that a large percentage of our physician spending is actually pretty variable. We stopped eating out, we stopped going out, we stopped traveling, and all of a sudden, we found that at least our spending went down when our income went down during the pandemic. I imagine that sounds familiar to many of you. Your income went down, but you're also not spending as much money. You may have also found out that you have more free time, or at least had more free time while we were in lockdown mode. Gave you a chance maybe to catch up on your CME, but it was also a great opportunity to become financially literate. If you are still in some sort of a lockdown mode, maybe you're not going on as many vacations as you normally would, this is still a great opportunity to become financially literate or potentially even start a side gig. I found that a lot of doctors in April and May all of a sudden became very interested in starting up a side gig of some type or getting involved in passive income, such as real estate investing. There's been a couple of real estate courses aimed at doctors that came out in the last few months, and 4 times as many doctors signed up for them this year as last year. It was pretty amazing to see how much interest there was there. But if you think about the purposes of investing, the main one we think about is building up our retirement nest egg. A secondary one is often paying for kids' college, but it can also be to build a source of an alternative income. So when your income does drop in future pandemics or other similar events, that you have another stream of income coming in. And for doctors, some common secondary streams of income include doing things with your degree. The fact that you're a doctor allows you to do some specialized kind of work that isn't actually clinical practice. That might be medical legal chart review. It might be chart review for insurance companies. Other docs kind of look for stuff outside of medicine, whether it was real estate investing or entrepreneurship. Others got into paid writing and speaking gigs, even with not much of a conference scene out there right now, as you might imagine. People are doing lots of talks online to groups like we're doing tonight. Okay, the second lesson of 2020 that I think was worth pondering about is the benefit of a written plan and the fact that following a written plan works. You know, when I drop into a slot canyon like this one, which is called Kaleidoscope Canyon in southern Utah, we have a plan for it before we ever go in there. As you can imagine, lots of things can go wrong in tight spaces filled with water like this. And it's the same in investing. You want to have a good, solid plan. And the best plans are the written ones. It's interesting. I get lots and lots and lots of questions about investing, but 90% of them are best answered with a simple question. What does your written plan say you should do in this situation? And the answer to that question, of course, is usually, I don't actually have a written plan. And so I encourage you to get a written plan because it's going to take care of most of your investing questions. So there's 3 ways to get a plan. The first, as I mentioned earlier, is to read some books, ask some questions on internet forums, write the plan yourself. It's cheap, but it's very time consuming. Okay, it's the way I learned. If you don't want to spend any money, you can borrow the books from the library. It really can be done almost free, but you'll have to become a little bit of an investment hobbyist in order to do that. You can also take an online course. I put one together a couple of years ago called Fire Your Financial Advisor. You don't actually have to fire your financial advisor. The course will just help you work better with them if you like having a financial advisor. If you find that you have a very bad financial advisor after taking the course, you can fire that person, of course. This is a little more expensive, but it's less time consuming than having to read all those books yourself. You can also take the shortcut, which is to go out and hire a financial planner. It costs thousands of dollars to have a financial plan written up for you, especially if you're going to have them implement and carry out that plan, but it does require the least amount of time. If you need help hiring a financial planner, we keep a list of ones that we trust on the whitecoatinvestor.com website under the recommended tab. But however you get the plan, it's important to have it in place because it helps you, and it particularly helps you in stock market downturns. Here's an example of how our written plan helped us. So in March, the stock market dropped about 35% over the course of 1 month. And that leaves you with the question, should I sell my stock mutual funds? Should we use our cash to buy more? Should we trade our bond mutual funds for more stock mutual funds? Should we trade our stocks for gold or Bitcoin? You know, when dramatic market events happen, we get these questions. And so what's the question we should ask ourselves? Well, what does the written plan say we'll do when the stock market drops 35%? And all we had to do was go back to our written plan and look at it. And this is what ours says. And if you'll see, this is a plan that we haven't even revised for 13 years. But this is what it says. It says, we'll not panic and sell securities due to market corrections. We'll rebalance our asset allocation as frequently as necessary, using a 5-25 rule, using new investment money as much as possible. And we also wrote in there that any significant changes to this plan require a 3-month waiting period for reconsideration. So we couldn't just redraft the plan in March because it wouldn't have taken place for months. So in order to follow our plan, we didn't sell any of our stocks. In fact, we ended up buying more because we were rebalancing the account and putting new money in them. So how did that work out for us? Well, we followed our plan, and here's the rest of our story. If you'll look at that nadir, in the 3rd week or 4th week of March, you'll see that the market came back pretty quickly. It's not 100% back, but it's almost all the way back. And anybody who panicked and sold in March really lost a lot of money that used to be theirs. And so by keeping a long-term perspective and following a written plan, it helped us to avoid making any mistakes. And you know what? It did the same thing for us in December of 2018 when the market dropped 20%. The same thing in 2011 when the market dropped 20%. The same thing in 2008 when the market dropped almost 50%. And so the plan really does work. We wrote it up in residency and we've been following it ever since. And it's helped us become financially independent in our 40s. Okay, lesson number 3 from 2020. Here's a picture of us in that same canyon eating lunch. And I want to encourage you, when you see a free lunch, to eat it. And in times of economic turmoil, oftentimes there is a free lunch. You know, they say there's no free lunch, but that's not always true. For example, there was this stimulus, and they're talking about another stimulus here in the Senate right now. But it's basically $1,200 per adult and $600 per kid. Unfortunately, most doctors didn't qualify due to their income. It was only for people who make less than doctors, unfortunately. But, you know, it was a nice free lunch. What we did get, however, is the Paycheck Protection Program. Now, if you are a self-employed doctor, whether you are in a partnership or whether you are an independent contractor, this was your stimulus, and it was way better than the stimulus everybody else got. Technically, it was a loan, but it's a forgivable loan for up to 2 months of payroll expenses. So instead of getting $1,200, you got up to $16,667 in salary for you and each of your employees, plus other payroll expenses like 401k contributions and health insurance, plus any rental expenses your practice had. And they clarified a couple of weeks into the program that partners qualify as well. And so it was really quite a big free lunch for most doctors. If you were paying attention and you applied for it, you could have gotten, tens of thousands of dollars that would have made up for a lot of the losses you had in lower clinic volumes, and certainly would have allowed you to carry out the main goal of this program, which was for you to not fire all your staff. And so that was a free lunch. And if you're paying attention, you got to eat it. They're talking about an additional chapter to this Paycheck Protection Program for this fall in the Senate right now. So pay attention to that. It may be another free lunch that is available to you. Okay, so when it comes to these government free lunches, you're certainly going to pay for them down the road, right? You're certainly going to pay the taxes. High earners typically pay a lot of the taxes, and they also tend to bear the burden of any inflation that's used to pay for these expenses. That's another way the government can get rid of their debts, is to inflate them away. So you might as well enjoy the benefits if you qualify for them. And since most doctors' income did drop significantly, they qualify for these sorts of programs. Okay, lesson number 4 from 2020. There were a lot of things that you could do in a bear market that were really useful. You had to be careful, just like this picture of canyoneering. There's potential to, make mistakes and cause yourself some pain. But if you paid attention, there were also some great opportunities in a bear market. And I'm going to go through some of these one by one. Perhaps the best one is to assess the quality of your plan. A lot of people in the throes of this bear market in March and April realized they needed a plan, or that their plan was not very good. Perhaps they realized, I don't have enough cash set aside. I need a bigger emergency fund. Instead of having 1 month of expenses set aside, maybe I need 3 months or 6 months or 12 months. You might also ask yourself whether your risk tolerance was what you thought it was. If you found yourself in the 4th week of March laying awake at night worrying about your investments, you're probably investing a little too aggressively. And so that was a good opportunity for you to actually do a gut check on what your risk tolerance really is, because it was a pretty significant bear market. It dropped a total of 35%. Which is, not the biggest bear market we've ever been through, of course, but it was certainly enough that it gave you a good chance to assess your ability to tolerate the loss of money you used to have that you put into investments instead of remodeling your kitchen with. It also gave you a chance to practice good investor behavior. For a lot of people, that means when the stock market goes down, they don't look at their statements, they don't log in, they don't watch financial TV. They just try to stay the course with their investments. And so it was a good opportunity to do that. Another thing you can do during bear markets is to buy stocks on sale. The truth is, you're getting the same great companies when you buy stocks. It's still Amazon, it's still Apple, it's still Walmart, it's still Exxon, it's still these great profitable companies, but now they're being sold at a new lower price. It's funny that stocks are the only thing that we buy less of when the price goes down, when we really ought to be buying more. So how do we buy more? Well, one of the main ways is we rebalance the account back to the percentages dictated by a written investing plan. So if your plan says you're going to have 70% of your portfolio in stocks, and the bear market causes you to only have 60% in stocks, well, you swap some of your bonds or some of your cash for stocks and rebalance the account. And by doing that, it essentially forces you to buy low and sell high, which is exactly what you want to do rather than the opposite. It's also an opportunity a lot of times to spend a little bit less so you can invest more money. Maybe you put off major purchases like that kitchen remodel or that new truck, and you redirect that cash into the market and then start saving up again for those savings goals. So it's a great opportunity to buy stocks on sale. In fact, some people even take this to the extreme, and in their written investing plan, they say they're going to over rebalance. If the stock market drops 20%, instead of rebalancing back to 70-30 or whatever their percentage they wanted in their portfolio was between stocks and bonds, they decide they're going to go to 75-25. So they're actually buying more stocks when the price is low and lowering the average cost per share of those stocks. I would encourage you to only follow what your written plan says in this regard, rather than trying to wing it and just going on gut feel. That tends to get into market timing, which most of the time ends up biting you in the butt when you try to do it. Here's another great thing you can do in the bear market. You can actually go out and buy stuff. If you've got your ducks in a row, you've got plenty of cash set aside, this is not a bad time to buy things. I found in the 2008-2009 bear market, when I went to buy a car, that nobody else was on the car lots. And you could really get a great price on cars. And so you'll find that during bear markets and the often associated economic downturn, that you can buy cars and houses and vacations and toys for much less than you would at other times. So while it's great to buy stocks, it can also be great to buy other stuff as well. So if you have cash or you have income, as docs usually do during bear markets, take advantage of that. Here's another thing you can do when you lose money. If you invest outside of retirement accounts, that is in a regular old brokerage account, i.e. a non-qualified account or a taxable account, and you lose money on an investment, you can have Uncle Sam share the pain with you. This is called tax loss harvesting. And anytime you sell something with a loss, you can use that loss on your taxes. Up to $3,000 a year of it can be subtracted from your ordinary income, and any that you don't use can be carried over to the next year. An unlimited amount can be put up against any capital gains you might have. So this is a great way to lower your taxes. But you don't want to necessarily sell your stocks low. So what you do is you sell them for something that's very similar, not in the words of the IRS substantially identical, but very similar. So you might switch from a Vanguard total stock market fund to a Vanguard 500 index fund. These are not substantially identical investments. They hold thousands of different securities. And so their correlation is very high. So you're essentially buying a very similar investment, but it's not the same investment. So that allows you to book that loss, to harvest that loss, and use it to lower your tax bill. And so that's a great thing you can do in a bear market if you see that you have investments in a taxable account with a loss. Something else you can do is you can do Roth conversions. Now, I wouldn't necessarily do this if you weren't planning to do it otherwise, but if you're in that time of life when a Roth conversion makes sense, this is usually a low income year, like a year you take a long maternity or paternity leave, or you take a sabbatical, or maybe you've cut back to part-time as you move toward early retirement, or you're in early retirement, then Roth conversions can often make sense. This is when you prepay your taxes by moving money from a tax-deferred account or a traditional account, like a traditional IRA or traditional 401k, to a tax-free account or a Roth account, like a Roth 401k or a Roth IRA. And in a bear market, because you only pay taxes on the amount you convert, it actually costs you less in tax to do these Roth conversions because the amount you're converting is less because you lost money. So you own the same amount of shares in the Roth account as you owned in the traditional account, but it costs you less in tax than it would have in a bull market to do that conversion. Here's another great thing that you can do in a bear market. A lot of doctors find when they become financially literate that they've got a couple of investments they maybe wouldn't have bought again. We call these legacy holdings. They're kind of investments you're stuck with because they have capital gains and it would cost you a lot of tax money to sell. Obviously, this only applies in a taxable account. You can buy and sell any time in a 401k or a Roth IRA or other tax-protected account without any tax consequences. But in a bear market, just like it costs you less to do a Roth conversion, your capital gains are less because it's fallen in value, and sometimes they disappear altogether. And so it's a great opportunity to finally get that portfolio that you actually want to hold for the long term, to swap out those legacy investments for better ones. So it can be a great time to rejigger your portfolio a little bit that way. It can also be a great time to reduce estate taxes. Remember that most doctor estates are never going to owe estate taxes. As you remember from the net worth question we had earlier, most doctors aren't worth $5 million, much less more than $12 million, which is when they start paying federal estate taxes. You see your first $11.58 million, or double that if you're married, is exempt from federal estate taxes. And so if you don't have more than that, you don't have an estate tax problem anyway. But if you're one of those lucky few who does have an estate problem, giving assets away to your heirs during a bear market when they're worth less uses up less of that exemption. And so it can be a smart move. Now, obviously, if you're given to a charity, you kind of want to do that more in a bull market to maximize your deduction for doing so. But if you're given to heirs, you want to do that in a bear market, as it will help you to give more to them while using up less of your estate tax exemption. All right, let's talk about some dumb things. This is a dumb thing I did. I actually went canyoneering on New Year's Day, and it turns out that there's a lot of ice in canyons in southern Utah on New Year's Day, and the water's very cold. Now, if you dress up right, it's still not too bad, but it's it's still kind of dumb. And in a pandemic, doing dumb stuff that was dumb before the pandemic, before the bear market, is still dumb. It doesn't somehow change just because the markets are in turmoil. So let's talk about some of the dumb things that investors do. Timing the market is a big one, and it's so tempting. When the market's going up or down 5 or even 10% a day, you look at it and go, man, I could make tens of thousands of dollars if I could just buy and sell on the right days. But what you need to remember is that you're an investor. You're not a trader. You are buying these assets for the next 30 years, not the next 30 minutes. You should follow your written investing plan, even if you're being tempted to time the market. Warren Buffett said, I never have the faintest idea what the stock market is going to do in the next 6 months or the next year or the next 2. Jane Bryant Quinn, famous columnist, said the Market Timers Hall of Fame is an empty room. And Jack Bogle, the founder of Vanguard, said, I do not know of anybody who's done market timing successfully. I don't even know anybody who knows anybody who's done it successfully and consistently. So while it's tempting, the likelihood of you doing it successfully and consistently and coming out ahead of the market, especially after paying the costs and taxes of doing so, is pretty low. Here's another one, day trading. You know, I remember back in 1999 to 2002, people were doing this all the time. Doctors were doing it between patients. Some of my med school colleagues that were fortunate enough to have some money were doing it in the lounge between classes, you know, buying and selling WorldCom and Enron and Pets.com, all these great stocks that were about to make millions. And of course, they all got cleaned out when the market went down and they had mistaken a bull market for their own skill. Well, apparently it's coming back. According to this article this week in the Wall Street Journal, investors opened 260,000 retail accounts at E-Trade in March, and Robinhood had 3 million users, this new brokerage that makes it all exciting to day trade. You know, when you make a trade and make money, they have balloons and fireworks go off on the screen to kind of reinforce that behavior. But the truth is, day trading was never a very smart move, and it's still not a smart move. Again, you're trying to invest for 30 years. You're not investing for 30 minutes. So don't get sucked into day trading. Here's another one, picking individual stocks. Okay, it turns out that most stocks are losers. The stock market overall makes money, but that comes from the relatively few winners in the market who do well. And it's a very well proven fact that most stock pickers trail the market. They would have done better if they had just bought all of the stocks via a low cost index fund, especially when you apply costs, and especially after you apply the taxes of all that buying and selling. So rather than buying individual stocks and taking on this uncompensated risk, any risk that you can diversify away is by definition uncompensated, use mutual funds. Mutual funds are where a bunch of investors pool their money together so that they can take advantage of professional management, pooled expenses that are thus lower per investor, and daily liquidity. You know, and you can really take advantage by using mutual funds rather than trying to pick your own stocks. However, you don't necessarily want to pick actively managed mutual funds. Remember, there's 2 types. There's the mutual funds that buy everything in the market and just try to keep their costs really low. Those are called index funds. And there are actively managed mutual funds where the manager tries to pick the good ones and avoid the bad ones. But if you look at the record of actively managed mutual funds, it turns out that over relatively long time periods, the vast majority of professional stock pickers, these mutual fund managers, trail the market too, especially after costs and especially after taxes. Only about 10% over 15 to 20-year time periods end up beating the market. And so you're really rolling the dice if you're trying to pick an actively managed mutual fund that's going to beat the market. You're probably better off just getting the market return by using a low-cost, broadly diversified index mutual fund or exchange traded fund available at common places like Vanguard, Fidelity, Schwab, and iShares. Okay, here's one that people think is a great idea in a bear market: leveraged inverse ETFs. So these are investments that go down when the market goes up and go up when the market goes down. And yet they also add leverage to it. So when the market goes down, they go up a lot. And when the market goes up, they go down a lot. Unfortunately, because these are a trader's tool, over the long term, this doesn't work out very well. Not to mention the fact that you need a functioning crystal ball to make it work. If the market goes up when you think it's going to go down, you can get cleaned out in a hurry, especially with all that leverage on board. These really are not tools for serious long-term investors. Here's another one: shorting the market. So this is when you first sell a fund or a stock or another investment and then buy it later. I know it sounds a little goofy, but that's the way it works. So if the market falls, you win because you sold at a high price and you bought at a low price. But since the market usually rises, you usually lose when you short the market. It's really a gamble. If you want to gamble, try roulette. The odds are much better than shorting the market. They're almost 50%. Same thing with buying puts. Okay, these are a type of option. Think of it like shorting the market on steroids. It's a really easy way to lose your entire investment and really should be avoided by long-term investors with their serious money. This is not something you want to get in the habit of doing during bear markets. Here's another one. People just get so upset about the fact that their stocks went down in value temporarily, even if it's only for a few months. And so they want to go invest in something else, anything else. And so they fall prey to lots of investment scams. They fall prey to alternative investments. You know, one of the most famous ones out there right now is Bitcoin, which is a cryptocurrency that nobody actually uses as a currency. And people think it's a good store of value. But the truth is, it's not a stable currency. People don't use it as a currency. It's not really stable at all. Its price is all over the place. And it's really not an investment in that respect. It's just a speculative instrument. Or they may go to something that's really, really conservative, like whole life insurance, where the returns are so low, especially in the first decade, that you sometimes would have been better off putting your money under your mattress. Or they get really crazy and start getting into the prepper thing, and they put all their money into AK-47s and canned goods, right? Well, it's not a bad idea to have some food storage, and might not even be a bad idea to have a rifle around. It's not really an investment either. But one of my favorites that people go to is Beanie Babies. Now, this was back in about 1999 when people went crazy about Beanie Babies, and they went up in value like crazy. It was a true bubble. And, you know, one of my favorite pictures on the internet is this one. This is a couple in divorce court who are literally splitting up their Beanie Babies. And if Beanie Babies or something similar, some other speculative investment, makes up a significant portion of your portfolio, you're doing this investment thing all wrong. Now, if you want to put 2% of your portfolio into Bitcoin or gold or Beanie Babies or whatever, fine. But if you're talking about putting 20, 30, 40% of your investment into these speculative investments, that's probably a mistake that you're going to regret. Okay, so before we get into the Q&A stuff, let's review some of what we've learned. We've learned that you want to become financially literate. You need to become financially literate. If you don't, you're going to pay a price in your life. We learned about the importance of a written financial plan. It will help you not only in bear markets, but it will help you to prevent and treat your burnout. You need to boost your income and spend carefully, win on both offense and defense. Remember that your income is not as secure as you thought. Use that written investing plan to avoid selling low in bear markets. Take advantage of any free lunch in there that there might be. Take advantage of bear markets for opportunities like purchasing securities at reduced prices, to invest, to buy things that you would have bought anyway, and to reduce your taxes. And remember that dumb investing ideas are still dumb in a bear market. All right, I think that brings us to the end of the formal presentation, but the best part of the presentation is usually the Q&A. So, Rob, you want to take over there and go over the questions here?
Absolutely. Thank you so much for that great information. We have a bunch of questions here. We'll get to, we'll get to as many as we can. And again, as I mentioned before, if we can't get to them, we will include those in our blog post and we will email that out to everyone. The first one here was interesting. We talked about this a little bit earlier, but is this bear market a true test of one's risk tolerance, or was it too wimpy?
Well, I mean, it dropped 35%. That's a pretty good bear market. Is it the worst bear market of all time? No. I mean, in the Great Depression, stocks dropped 90%. In 2008, stocks dropped 50%. And real estate investment trust dropped 78% in 2008. So it's not the hugest bear market ever. But I think it's a good enough test of your risk tolerance. If you found yourself that fourth week of March going, man, I should have more money in stocks. Man, this is a great time to buy. I think you discovered that your risk tolerance is higher than maybe you gave yourself credit for. If you laid awake at night and were popping Tums every night in March, I think maybe you need to dial back the risk a little bit.
Okay. Is this the time that small cap value makes a comeback? Has history shown that for this asset class?
Okay, so lots of investors like to tilt their portfolio to very small stocks that are on the value spectrum, meaning stocks that are kind of beaten up, not in favor. They're not the growth stocks that you've heard of, the Apples and the Netflixes and the Zooms, you know. Because the data shows in the long run that small cap value stocks outperform the overall market. That has not been the case for the last 10 or 15 years. And so whether that is going to reverse in the next year or 5 or 10, I don't know. I would need a functioning crystal ball to say that. But there is some pretty good data suggesting that it does outperform the overall market in the past when it has come out of bear markets. And so I think it's a pretty good bet for the next 10 years, but I have no idea what's going to happen in the next year or two. So I certainly have a few small value stocks in my portfolio. And hopefully that bet will pay off, because for the last 10 years it has not.
Thank you. Let's see. Have you found your followers have had e-fund failures at how many months of expense? Was 3 months enough for most doctors?
So emergency funds, it really depends. I think in this case, 3 months was enough for most doctors. And the reason why is that our incomes kind of came back up within 2 or 3 months for most of us. You know, emergency department volumes came back, elective cases started proceeding again, clinic volumes came back. And so I think in this instance, 3 months did turn out to be enough. But for a lot of doctors, 6 months is not unreasonable, because you think about it, how long does it take to get a new job? If you were fired from your job, how long does it take to get a new one? Well, the credentialing process and the licensing process itself can take up to 6 months. And so I don't think it's crazy to keep 6 months of living expenses. Some people get really conservative and push that out to even a year. But I think if you've got more cash sitting around than a year's worth of expenses, I think you're probably got a little bit too much, and I'll just start looking for some longer term investments for that, unless that cash is earmarked for a specific goal, like paying your taxes or buying a truck or some dream vacation or a home upgrade or something like that. It's probably time to invest that money if you have more than that.
Okay, here's one. Somebody is interested in specific guidance for locums physicians about per diem, taxes and savings, other potentials of an LLC versus standard deductions.
Boy, that's about 12 questions in one there. Obviously, when you negotiate any contract, you want to negotiate as favorable of a contract as you can, right? So the more salary, the better. The more benefits that you care about, benefits you don't care about aren't very helpful, but the more benefits that you care about, the better. That might be your per diem, it might be a vehicle expense, it might be, the place you're staying, it might be your airfare. All these things are negotiable in a locums contract. So I encourage you to negotiate the best contract that you can. Now, obviously, there's a set pool of money, and most employers, most people hiring, don't really care where the money goes. If you want more in benefits and less in salary, that's not a problem. They're more than willing to work with that most of the time. But at a certain point, when you start asking too much, they start going, well, what's the next doc want? And that's when you run out of your negotiating power. As far as your business format, when you do locums, it really depends. I think most people probably do it just as a sole proprietorship. Remember, forming an LLC or forming a corporation does not shield you from malpractice. It only helps shield you from business-related liability. So unless you're trying to save on some payroll taxes, like your Medicare taxes, by splitting your income into salary and distributions, then I wouldn't bother with an S Corp. Or an LLC being taxed as an S Corp. I would just do it as a sole proprietorship. But if you're making hundreds of thousands of dollars doing locums every year, it's probably worth looking into the hassle of forming an S Corp for that and maybe saving some Medicare tax there.
Yeah, definitely. And I think we've got some posts about that on our blog on locumstory.com if anyone's interested in more information. So here's one. Jeff Harrison would love to be a guest on your podcast sometime to share his story. And his question is, should he put $100,000 into another apartment syndication or grab a rare opportunity to invest $100,000 in a very successful venture capital fund? Sounds like it normally has a really large minimum investment, but a relationship has given him this opportunity. So essentially accelerated depreciation versus possibly higher returns.
So here is the great thing about having a written investing plan. See, this is one of those 90% of investing questions that I turn to you and say, what does your plan say you should do? Does your plan say you should put money now into syndicated real estate? Or does your plan say you should put money into a hedge fund or a private equity fund or put it into boring old index funds? Whatever your plan says you should do, that's what I would do. But when you sit down, you know, and with a drink of your choice with you and any significant other you have and draft up this plan, that's the time to think about what you're going to do, rather than collecting investments as they come by, because investments will come across your desk every single day, you know, but there are no called strikes in investing. You don't have to swing at any of these things, but you will never run out of investments. There are always more investments than you have money to invest. And so I would encourage you to get a written plan in place. Now, if that written plan says you're going to put 10% of your money into apartment syndications and you're a little bit low on your percentage of your portfolio that's in apartment syndications, then I'd put that money into apartment syndications. You know, if you've decided that you're going to have some percentage of your money into these other alternative investments, well, look at the percentages. Are you short there? Do you need to put more money in there? If so, then put more money in there. But write yourself down a plan and follow the plan.
Great advice. All right, here's an easy one. Here's a softball lob over to you. Where can I find a financial planner?
Well, there are a lot of financial planners out there. There's lots of resources. You know, if you want somebody local that you can sit down across from, you can simply Google financial planner in your hometown. But what I have found is there are a lot of people that call themselves financial planners who are actually product salesmen, and they're trying to sell you insurance. They're trying to sell you loaded mutual funds. They're trying to sell you something else. And so I encourage you to use a financial planner that has served a lot of other docs, that offers a fair price and gives good advice, and has actually, you know, read the academic literature about investing, you know, knows that index funds are more likely to outperform actively managed funds, et cetera. So as a service to the community, and also as a way that we make money on our website, we keep a list of recommended financial planners. And so if you go to whitecoatinvestor.com, we have a recommendations tab. You can go down there and it has financial advisors there, and you can look at that. And there's a list of about 40 of them there. And I think you can probably find somebody there that you will be a good match with. But certainly, if nothing else, looking at that page will give you an idea of what a good financial planner looks like. So even if you want to go out and find your own, you'll kind of know the questions to ask.
Great. Here's one clarifying something you mentioned earlier. What is the 5-25 rule? Okay,
so this is a rebalancing rule. Remember, if you have a written investing plan and your plan is to have 25% in this particular type of investment and 50% in this type and 10% in this type and 15% in that type, and you get to the end of the year and you realize that the percentages are off, what you should do is rebalance back to the original percentages. You sell the asset that has done well and you buy the one that has done poorly, so that your risk is the same this year as it was last year. And that is called rebalancing on the calendar method. A different way that some people rebalance is what's called the 5-25 rule. And this is a rule that says you rebalance when your portfolio gets a certain amount out of whack, even if it's not the end of the year. So for a large asset class, perhaps one that has 30% of your portfolio in it, when it gets out of whack by more than an absolute 5%, you rebalance it. So if you're supposed to have 30% in there and it grows to 35%, you sell back down to 30%. That's the 5 part of the rule. For a small asset class, perhaps one that makes up only 25% of your portfolio, you use the 25 rule, and that's a relative 25% of the asset class. So if that one went up to 6.25% of your portfolio and it's supposed to be 5% of your portfolio, you would sell back down to where it was 5% of your portfolio. So that's the 525 rule. It's a more complicated way to rebalance your account than just doing it once a year, but some people prefer it, and that's the way my wife and I decided to do it. So that's why that's what's in our written investing plan.
Great, thank you. There's a couple of questions about a very large, very well-known insurance company and about whole life and what your recommendation is on whole life.
Well, there's always questions about that large insurance company that seems to seek out docs and rhymes with Northwestern Mutual. But, the truth is most doctors at some point in their career are going to be approached by one of these agents with a pretty hard sell to buy a whole life insurance policy. What a whole life insurance policy is it's basically an insurance policy that will pay you whenever you die, no matter when that is, even if you die at age 100. And because all of us are going to die eventually, buying life insurance that pays out to everybody that buys it is a pretty expensive thing to buy. And so it's expensive life insurance. It has this other feature where you can borrow against this death benefit that it's accumulating. And depending on how much you've paid for it over the years, you can borrow against it a certain amount of money. But there's not 2 pools of money. There's just the death benefit. When you buy, you got to pay back, or when you die, not buy, when you die, they take that death benefit, they pay off any money that you borrowed out of the policy, and then give your heirs the rest of the death benefit. So it's not some other extra pool of money, you're just borrowing against your death benefit. And the truth is that cash value as it grows is not a very good investment. For the first 5, maybe even 10 years, it has a negative return. And so it's not a great investment. You can do better even with very conservative investments than that. And so people get suckered into buying it because it's sold as this tax-free great investment. Well, just because you can borrow against something tax-free doesn't make it a great investment. You can borrow against your house or your car or your stock portfolio tax-free too. But that's not something that is necessarily a great investment. And that's really the only unique thing about whole life insurance. So you get more expensive insurance than you need, you get a lousy investment, you combine the 2 together, and it's just something that the vast majority of people do not need. There's a few niche uses for it, but just being a doctor is not a niche use for whole life insurance. So I recommend you stay away from it. Don't get suckered into by that. You almost always have a better use for your money than buying whole life insurance. So buy relatively cheap term life insurance, buy a lot of it, and invest the rest so you can become financially independent and not need that life insurance by the time you're in your 40s and 50s and 60s.
Great. We've gone over time here a little bit. You have time for a few more questions?
Yeah, let's do a few more.
Okay. Here's one. Early career physician. He asks, if you are aggressively retiring debt, you think you should pause that during the pandemic to build up a really robust emergency fund?
Oh boy. So this requires a little bit of a crystal ball, right? I don't know if you're going to need your emergency fund. If it turns out you don't need it, then the right answer was to pay off your debt. If it turns out you need the emergency fund, you're better off having the emergency fund. So in general, when you're paying off debt, I think you ought to have at least a small emergency fund. If you have a particularly stable income for some reason, maybe you can get away with just a month worth of expenses as an emergency fund. But most attending physicians ought to build up at least a 3-month emergency fund relatively soon out of residency, even if it means they pay off their debt a little bit slower. So I guess if you don't have much of an emergency fund, I would get something set aside, at least enough to live for a few months in the event that something happened to your income before going too crazy about paying off your debt.
Great. We've talked a little bit about investing plans. Here's a question about an attendee is writing an investing plan for their family right now. How do I go about coming up with the correct asset allocation for me? Sounds like he's read your blog post about the 150 portfolios. He feels like he needs a little more something on asset allocation. And there was another question about investment plan. What are the most important points to have in an investment plan?
Well, I mean, the investment portion of the written plan, the most important point, I suppose, is your asset allocation, what you're actually going to invest in. And I think there's a few rules of thumb there. One, you need to make sure that you have risky assets in it. You got to have some stocks or some real estate, something where you actually have some significant risk of loss, because those investments are the only ones that are going to have returns high enough to actually meet your investing goals. If you invest your entire portfolio in nothing but safe investments like savings bonds and savings accounts and bonds and tips and whole life insurance and CDs and those sorts of things, you actually have to save 50% of your gross income for your whole career. You need those investments to do some of the heavy lifting. So you have to invest in some risky assets. And there's some guidelines put out there on how much should be in risky assets. Sometimes they say 100 minus your age. So if you're 30, that would be, 70% of it ought to be in risky assets. And that's a reasonable rule of thumb. But really, it's kind of a personal thing. And until you go through a bear market, you don't really know what your risk tolerance is, and it's hard to fine tune that. So my general advice is to pick something reasonable and stick with it, because the best portfolio can only be known in retrospect. It's okay to not have the best portfolio. Pick something that you like, that seems reasonable, and go with it. You want it to be diversified among multiple asset classes like US stocks and international stocks and bonds and real estate. Maybe if you believe in small value stocks, you put a small percentage into that. Maybe if you're into gold or something else, you put small percentage into that. And then you write it down and stick with it. It's far more important that you stick with your plan than what the actual plan is. And so I'm sorry, I don't give specific asset allocation advice, because it's only possible to know what the best asset allocation was in retrospect. And so I think it's more important to find something that fits you. But if you're not sure what to do, if it's just too vague, you can go someplace like Vanguard and just pick a target retirement fund or a life strategy fund and put all your money into that. And they will control the asset allocation for you in some sort of a reasonable mix. And so I think there's lots of reasonable options there. I hope that's specific enough for you.
Great. Last question. Let's see. Here's a question about rental properties. Is it worth it to form an LLC to invest in rental properties?
Yes, if you're going to buy rental properties, form an LLC. The benefit of that is it gives you some additional liability protection, and it gives you both internal and external liability protection. Now, this is all governed by state law, and so the amount of protection you get varies by the state. But what I mean by internal liability protection is if something happens at that property, right? Somebody slips and falls, cracks their head, gets a subdural, and they die. Their family sues you for more than that property's worth. Well, all they get is the property, right? It keeps you from losing your personal assets to that lawsuit. And so the LLC is beneficial for that internal liability. It is also beneficial for external liability. In most states, if you have a company, if you have an asset, if you have a multiple group of people that own this asset, you should form an LLC. That way, if just one partner of that asset gets sued, they can't take the asset away from the other partners. They're limited to what's called a charging order. And that charging order basically says, well, when the LLC distributes income, you get your share of it, or you get that person's share of it that harmed you. But the LLC is not actually required to distribute the income. So in reality, the threat you make in the course of this lawsuit is that you're going to have to pay taxes on income that you never received. And that gets people to settle for a little bit less money than they otherwise would, or even just go away completely. And so the LLC provides that internal and external liability. If you're going to buy rental properties, which are really fairly toxic assets from an asset protection standpoint, you should put them into an LLC.
Great. Thank you so much, Dr. Dolly. We really appreciate all your efforts to help all of us be a little more financially healthy. As I mentioned earlier, we will get the rest of these questions answered offline and get those posted on our blog when we post the video. And thank you to all of you who attended. It's so great to see so many people interested in doing these things to help their finances, because to your point, you know, being financially healthy and having all your ducks in a row can also make you a better physician, a better, you know, better parent, a better spouse. It can help you in so many different ways. So it's a super important thing. And if you want to keep hearing about our webinars in the future, make sure you go to our website, locumstory.com. You can sign up for our newsletters, and also if you want information about locums, if you've thought about getting into it. I know a lot of physicians are, as they've, you know, been furloughed or taken pay cuts. It's a great way to earn some income on the side, or potentially have a little more flexibility in your career longer term. Thanks again to everybody, and have a great night.